All right, next we're going to talk about the central bank, right? So in the last section we talked about the financial intermediaries, which are kind of one part or one half of our financial system. Um, the other part is the central bank, which we call the Fed. Okay, so you might have heard the Fed before, and in some cases, people use it to refer to like the government. But in economics, when we say the Fed, it means our central bank, the Federal Reserve Bank. So this is the central banking system of the United States, and it has been the most important regulatory agency in the U.S. monetary system or the U.S. money system. And it was first established all the way back in 1913, over 100 years ago, by the Federal Reserve Act, which was signed by President Woodrow Wilson. So how is the Fed organized? What composes the Fed? This is outdated. These slides are from 2017. So the chair is no longer Janet Yellen. It is now, I can't remember his first name, Mr. Powell. But the Fed consists of a board of governors. So it's kind of like a board of directors for a business. It's a group of members that come together to collectively make the decisions that are going to occur. But the Board of Governors includes 7 members, and each member has a 14-year term, which is a pretty long time. Not sure why it's 14 years in particular, but that's what it is. And the chair was Janet Yellen back in 2017. It is now a Mr. Powell. And then there are several Federal Reserve banks dispersed throughout the country. There are 25 branches in 12 districts. We actually have one here in Atlanta. Our bank in Atlanta is the bank for the Southeast District. And then there's something called the Federal Open Market Committee, or the FOMC. It includes the Board of Governors, plus 5 presidents of the 12 district banks. And this is the main governing body that determines the course of monetary policy action. Okay, so here's a graphic of sort of how the organization of the Fed works. You've got your Board of Governors, which are these 7 appointed members that sit for 14 years. They do things like set reserve requirements and approve discount rates. They supervise and regulate member banks. They establish and administer protective regulations in consumer finance, and they oversee the Federal Reserve banks. They exercise supervision over the 12 district banks. So these banks propose discount rates, which they then approve. They hold these 12 district banks hold reserve balances for banks like SunTrust and Bank of America. They provide currency, so that's one aspect of those banks. They also, an important aspect is they collect and clear checks. So when you write a check or someone writes you a check, it goes to one of these 12 district banks. In fact, I think they've consolidated this into just the bank that's here in Atlanta. I think that's Atlanta, the bank in Atlanta is the only central bank that still does this. Written checks are kind of on their way out, so I think that's why they've sort of consolidated it into one bank now. And they also handle U.S. government debt and cash balances, right? So again, the bank for the federal government. These together compose the FOMC, right? The Board of Governors plus 5 of the presidents from these banks consist the Federal Open Market Committee. And then the Board of Governors gets some sort of external help and advice from Consumer Advisory Council, the Federal Advisory Council, and Thrift Institutions Advisory Council. So they get some external help from these advisory councils. All right, and then here's a map of the different districts and the banks. So like I said, Atlanta is the headquarters, so to speak, for the Southeastern District. There's a federal bank in Dallas, which is kind of this south region here. San Francisco is where this federal bank is for the western region. Minneapolis, Kansas City, Chicago, St. Louis, Cleveland, let's see, Richmond, and then there's one in Washington, D.C., Philadelphia, New York, and Boston. So interestingly, New York is by itself a district, which is pretty interesting. Oh, the other interesting thing is that Pennsylvania is split in half for some reason. So is Wisconsin. That's interesting. Oh, and Mississippi, and Tennessee. Interesting. And Kentucky. I didn't know that. All right, so what are some functions of the Fed? What are some of its purposes? So sort of its main purpose is to supply the economy with our fiduciary currency, right? Our currency that is backed by our confidence. But it also holds depository institutions' reserves. So when Bank of America or SunTrust have extra cash, they deposit it with the Fed, right? So the bank of banks. It also acts as the federal government's fiscal agent. So when the government is purchasing things, the Fed has that money and sends it to whoever is owed that money. It supervises and regulates commercial banks. It conducts monetary policy, which is another one of its major functions, and we'll talk about that actually in detail in the next chapter. It also intervenes in foreign currency markets, which is interesting. It gets in there and can, to some degree, manipulate foreign currency markets. And then this one is really, it's been exercising this last one in the past couple of weeks here, acting as a lender of last resort. So when the economy is in a really bad shape and commercial banks are running short on money, they really need an emergency loan, the Fed can step in and help them out. So looking at this in more detail, the Fed has a role as an institution that is willing and able to lend to a temporarily illiquid bank. So that means that the bank doesn't have enough cash to operate. That would, in otherwise normal conditions, be in good financial condition. And it does so to prevent it from creating a loss of confidence in that bank or sometimes in other banks. So can you imagine if you went to the bank and they were like, oh, sorry, we don't have your money? That wouldn't be good, right? You would lose some confidence in that bank for sure, and then maybe just in the banking system in general. So the Fed can sort of alleviate this and provide emergency cash to banks so that they don't end up in the situation where you go to the bank and the bank doesn't have your money. When many banks and non-banking financial institutions and other companies struggled with serious financial difficulties in the late 2000s after the Great Recession or during the Great Recession, the Fed acted as a lender of last resort and provided hundreds of billions of dollars in direct lender of last resort assistance to these institutions. And again, like I mentioned, they have done this again very recently in the wake of this coronavirus pandemic.